This is Let's Talk Energy, your go-to podcast for smart energy insights. I'm your host, Noah Brenner, and each week we're bringing you an inside look at the dynamics shaping the global energy industry through in-depth conversations with our own RystadEnergy experts, as well as some special guests. In today's episode, we're taking a deep dive into the epicenter of the global energy industry, the Middle East. Energy strategies in the Middle East have been unique and rapidly evolving over the past 5 years. When much of the Western world was limiting investment into new volumes of oil and gas, we saw Middle East players expanding their production, despite lower near-term prices. Yet, the next phase of oil and gas development in the region is poised to look very different than the giant onshore fields that have fed global markets for decades. At the same time, countries are rapidly scaling renewable power and harnessing artificial intelligence to make their energy production cleaner and more efficient. So, where does the additional oil from the Middle East that will be needed by global markets actually come from? And how could countries leverage rising gas production, both domestically and abroad? What does a modern energy mix for the region look like? And finally, what do these shifts mean for companies working there, for the OPEC Plus producers group, and global markets? Ahead of the massive ADIPEC Energy Conference in Abu Dhabi, I've got a pair of RystadEnergy experts with me today to help us understand just that. I'm joined today from Dubai by Aditya Saraswat, our research director for the Middle East North Africa region. Aditya, welcome to the program.
Thank you, Noah.
And from Sohar, Oman, we have Valerie Panopio, who leads our coverage of markets and refining in the Middle East. Valerie, welcome.
Thanks, Noah.
Well, let's talk energy. Set the scene for us here. How is energy in the Middle East changing? And also, what are some of the strategic thoughts? What are some of the strategic rationales that are driving the changes that you're about to tell us about here in the program?
Certainly, Noah. I think the Middle East as we know it before pandemic is completely different from Middle East as we know it after pandemic. And that is largely due to how capital allocation across the world, across the global players have changed, largely due to their assumption on liquids and gas demand outlook. Middle East, driven by core OPEC countries, believe in OPEC demand outlook, which sees increasing role of liquids and gas moving forward. So all the capital allocation that goes in the region is largely driven by increasing the capacity or leveraging the alternative energy sources and technological advancements to allow them to do that. When we look into these investment patterns, there are significant and transformative trends that come out in front of us. So one being gas being the new oil, second being offshore is the new onshore, third being OPEX is the new CAPEX, fourth being we have a strong push in adoption of alternative energy sources and technology, and lastly, a strong push in creating a low cost and low carbon resource base.
And Valerie, I wanted to bring you in here. How does this look from your perspective?
We see the same trends in refining post COVID, certainly an increase in refining capacity in the Middle East coincided with the countries opening up post COVID, which also supported higher runs. And then, in line with what Aditya was saying earlier, there's a very strong push towards diversification of revenue. And I think on the refining side, these oil majors are focusing more now on capturing the market, not just on the crude side, but also on the product side.
Let's unpack some of these 6 trends to help understand, again, what's driving them, but put some figures to what we're talking about here. Let's start with gas is the new oil. Obviously, the Middle East is home to Iran and Qatar, 2 of the largest gas producers in the world. But countries like Saudi Arabia haven't always been maybe major gas players. So it seems like the heavyweights are getting bigger, and some other countries are joining in. But Aditya, break this down for us.
For this decade, we estimate more than $300 billion worth of new projects will be sanctioned, and two-thirds of those are focused towards gas and LNG. And yes, as you rightly mentioned, Qatar being the main player, expanding their LNG capacity, But we are also seeing significant expansion projects in Saudi Arabia and UAE, where they would like to expand their gas and LNG capacity. So the core for the Middle East is to become gas self-sufficient, and for the countries which can, they want to increase their net gas export capacity. And there is a significant pivot in capital allocation between oil and gas starting from pandemic.
Valerie, I would think that has implications for crude burn, burn of crude and fuel oil within the power sector. And so, tell me a little bit about how that could potentially free up additional molecules that could then be exported or used elsewhere.
Currently, the level of crude burn in the Middle East, and this is primarily centered on Saudi Arabia, Iraq, and Kuwait, it's around 750,000 barrels per day of direct crude burn. And to add to that, there's about 1.2 million barrels per day of fuel oil and distillates that go into power generation. So definitely there's going to be some replacement or displacement actually of molecules with gas coming in the power mix, freeing up some exports, of course, of fuel oil distillates. And in fact, during the summer season, the Middle East approaches actually a point where they become net importers of fuel oil because of the increase in demand for power generation during the summer season. So definitely the rise of gas as a source for power is going to free up more of these molecules and release that into the market and potentially put some cap or a ceiling on the price of fuel oil.
Valerie, I wanted to stick with you on this idea of downstream being the new upstream. I mean, across many geographies, I guess, but particularly the US and Europe, we've seen refining capacity decline. As companies either close refineries or shift them to biofuels. But in the Middle East, we've seen new refineries being built. We've seen existing refineries being refurbished. I mean, just how much has domestic refining capacity increased?
Since 2019, there has been an increase of 2.4 million barrels in crude distilling capacity. And that, of course, does not translate 100% to the increase in the run rates, but run rates have also increased by about 1.2 million barrels. And if you put that in contrast with how much the demand in the region has actually increased, and it's not very fast, the demand has only increased by about 4.5% or about like less than 500,000 barrels per day. So the significant increase in refining capacity and run rates has also contributed to the increase in exports in products that are coming out of the Middle East.
Why is this happening? I mean, is it about being able to export those higher value products? What's kind of driving the strategy here?
Definitely a step towards diversifying the revenue of these countries. Prior to 2020, they were very reliant on exporting crude, and much of the revenue is really dependent on how high or how low the crude prices fluctuate. So after 2020, and specifically after 2022, we've seen a significant increase year on year in the exports of products coming out of the Middle East, about 1% year on year. And in 2025 year to date, they account for about 26% of the global refined products export. So you can think of it as that's the share in the market that's coming out from the Middle East. So certainly a significant share. It also has the potential to grow further because there's still room for the CDUs to increase. And meanwhile, we're seeing a lot of attrition in Europe as well as in the US of refineries closing down.
Well, how has this impacted trade flows? I mean, if we've got supply diminishing from a couple of maybe traditional areas where we would have had production, and then we've got supply increasing in the Middle East, what's been the dynamic in the market there?
The Middle East is in a very optimal position to take advantage of flows going east and west because they sit right in the middle. They have taken advantage of the void that was left by the sanctioned Russian barrels, sending middle distillates to the west, gasoline to the west, and also to some extent, China's exports have reduced in the last couple of years, and exports of LPG, naphtha, fuel oil from the Middle East has been flowing to Asia. And I think the Middle East has played sort of like a referee in terms of prices. They've kept prices in check. Every time we see some disruptions in supply owing to some geopolitical tensions, the flows that are coming out of the Middle East have been keeping product cracks in check in these regions.
Excellent. Aditya, I want to turn to you. Offshore is the new onshore. Tell me what you mean by that.
We have close to 30 million barrels per day of crude oil production capacity in the Middle East. And again, two-thirds of that is based onshore. And most of these fields have been producing more than 30 to 40 years from now. So there's an increasing declining base. And to further grow from here, we see a base which is largely peaked and very little upside. But on the other hand, we have fresher barrels with high resource size in offshore, which can support this growth. So as a result of which, we are seeing a clear sign or clear indications that Middle East in general is pivoting towards offshore, getting expansion barrels from there, and at the same time allowing infill drilling and workover activities to maintain the current onshore base. And that is from the oil side. When we shift focus from the gas side, of course, it houses one of the biggest gas fields in the world. We have a lot of non-associated gas present in the offshore waters of the Middle East, and that is where the capital is being flown as well. So I think the collection of two, both from oil as well as gas side, there's a strong offshore focus which is up and coming. That's where we see going back to the $330 billion cumulative sanctioning tally. Two-third again, I believe two-third is the new reference figure for us. Two-third of that is in offshore. So it's a clear pivoting signs towards offshore capital allocation.
Isn't offshore oil more expensive? I mean, one of the Middle East, core advantages is that low cost of production. Are these new barrels going to have higher break-even costs than previous?
When we compare that against onshore Middle East, certainly yes, it is slightly more expensive. But when we compare that against rest of the world, it is one of the most competitive barrels out there. So Middle East shelf resources, these oil resources are due to the size of the resource sizes and the scale at which these projects are rolled out. Middle East NOCs have always gotten this competitive edge in terms of break-evens. But then if we have to maintain what we have, it would increase your OPEX because we have to replace these onshore resources which are drawn through production. And then we have to keep on drilling more wells and invest incremental CAPEX and OPEX every year to maintain the pace. We have to accommodate this CAPEX in the near term so that in the future, we have a very flexible supply base, a low cost supply base to react to any market calls from these OPEC core NOCs.
Valerie, I just want to bring you in here. Does this change the crude production slate for the Middle East? If the fields move offshore, if we're tapping new fields, are the barrels being produced the same barrels?
We expect, of course, a change in the qualities from onshore grades to offshore grades. Likely, there's going to be a shift from more of a light, medium sour production to a more medium to heavy sour production. And actually, this is in line with the capability of complex refineries in the region, and especially in Asia. The new refineries that are being built in China and India are fully equipped to handle the heaviest and sourest crudes. So I guess this is supporting also the loading of the downstream units. And in terms of margins, it just means more upgrading, more margins.
Let's come back, Aditya. OPEX is the new CAPEX. You mentioned the role of OPEX here, but you're saying perhaps those are the figures that will matter as much, if not more, moving forward.
Whenever we see Middle East from activities point of view, the first thing that comes up is the oil and gas expansion targets. And most of these targets are within reach. We are seeing these targets will be reached within the next 2 to 3 years for the key expansion project hosting countries like Saudi Arabia, Qatar, and UAE. But post that, we have to understand that you don't go to these higher target levels and come back. You go there to sustain. And to sustain, we need to continuously maintain and modify your facilities. You make sure that you provide enough sort of brownfield support to these facilities and fields. And on the top of that, it would require significant amount of OPEX segments like logistics, transportation, etc., to ensure operational readiness of these facilities. So on per barrel metrics, we see OPEX outpacing CAPEX in the years to come. And that is exactly what we have been presenting in the region, because supply chain players would like to align themselves moving forward. But what are the key oil and gas segments they should be focusing on?
But you're saying both the level of investment as well as the opportunity for companies that are looking to provide services is on the operations side rather than the capital investment side.
Yes, any future growth is towards, we believe, OPEX side. On CAPEX, certainly there would be some brownfield elements to it every now and then. But on to support the production readiness of these facilities, the OPEX segment would create a new market opportunity for the supply chain players.
And Valerie, I mean, we've seen expansions in refining capacity. Does a similar dynamic hold there, where you have additional OPEX that's needed to maintain that, or is it different?
The strategy or the approach is slightly different when it comes to OPEX and then CAPEX. Of course, when a refinery is new, you would have to infuse some OPEX to maintain the capability to where it is. But as refineries age, the cost of OPEX, maintaining that refinery to where the capability is at the moment, and keeping it competitive is becoming more and more expensive. So in the world of refining, especially in the current market environment, and the name of the game is infusing more capex, adding more units that are more complex, enabling the refinery to process more more sour, more heavy crudes that will give it more margins to process the cheap crudes to come up with high valued products such as middle distillates and gasoline.
Aditya, you had mentioned this strong growth in alternative energies and new technologies. What impact, I guess, first, can you quantify that a little bit? And then let's talk a little bit about that impact in the energy landscape.
What we like to call it the power mix of the region. The gas accounts for roughly 80 to 90% of the entire power mix. But when we look at the level at which the solar and rest of the alternative energies are being taken up and installed, we are getting not only record amount of capacities being installed, but also at the record low cost delivered of these power units. So moving forward, gas still plays a big role. Close to 55 to 60% of power mix comes from gas, and the gap there is being taken up by solar moving forward. But then when we look at these trends, it is by no means to displace oil and gas investments, because the region is looking at energy transition very pragmatically. It is playing both sides of the puzzle. From the demand side, they would like to displace the molecules by homegrown electrons, and these molecules will then be fed to international markets where it can bring more value to the operators and the countries. And that's exactly the two double-edged sword of attacking the energy transition driven activities that we are seeing in the region.
But as you pointed out, I mean, these countries have perhaps the best solar resources in the world, and perhaps the ability to deliver the lowest cost electrons, possible from some of these, particularly solar developments. But there are also wind potential in other areas. So, is there, I guess, a domestic power supply angle to this as well, in terms of getting the most electrons onto the grid in the fastest way possible?
Domestic grid and domestic power mix is completely going to transform. We are already seeing that happening in the region. Also, we have to understand, with this sort of strong solar and wind energy potential, it also allows the region to also unlock opportunities in green hydrogen. And with ample amount of gas, it also allows them to open up blue hydrogen opportunities as and when that market matures. But what's more encouraging is that the supply chain players are also increasing their base in the region, and they are making alliances with the operators, making alliances with the players to ensure both sides of the party reduce their capital as well as technological undertaking. So it is scripted for success as and when these developments come in. We see very little risk of at least these renewable projects to be further deferred or any cancellations for that matter.
I think that leads really nicely into to your last point of these six key shifts that you highlighted, which is this increasing push toward both lower costs and lower carbon intensity. So, Aditya, why don't we start with you in terms of kind of what's driving that push and how are we seeing it manifest both from the operator and the supplier side?
In the long run, the region believes that not only low cost but low carbon barrels will be feeding the demand. And to accommodate that, they are leveraging every bit of new technology, including AI, etc., to kind of map out the operations and find out the efficiency gains in the region. Secondly, the region is also opening for international investments through financial institutions, and then there are a lot of equity partnerships and IOCs are eyeing to be part of this growth story. And a large part of the consideration for international institutions, including the international oil and gas players, is to look at not only low cost barrels but sustainability matrices as well. So Middle East is positioning itself through adoption of latest technology, ensuring their sustainability matrices are in place so that they can further leverage these partnership moving forward as the energy transition scales up and increases the requirement of having lower carbon footprint of pure oil and gas operations.
While different region, different outlook on perhaps energy demand and the way to meet that demand with supply, but still some of those same considerations about lowering carbon in order to access global capital markets, but also to have simply for efficiency's sake. Valerie, how does this play out in the downstream, or how are you seeing perhaps this play out in the downstream, this low carbon, low cost?
In the downstream, the push is really towards producing more sustainable fuels, so biofuels and investments on enabling biorefineries are becoming more prevalent now, especially in Europe. And in some parts of North America and more advanced countries in Asia. I don't see this becoming a trend yet in the Middle East. It's not significantly in the center of some investments that I'm hearing or seeing in the Middle East. Not yet, at least for now.
Look, we've highlighted these six really interesting trends that have been unfolding, say, over the past 5 years and perhaps will continue to unfold over the next five. But let's look out a little bit further ahead. What does this mean in terms of future trends? What is it that you're keeping an eye on? Aditya, let's start with you.
Starting from OPEC, it will be quite interesting to see how these core OPEC countries balance the demand growth as well as the non-OPEC plus supply growth moving forward. Up until now, they have shown good restraint, and any sort of change of strategy will send ripple effect across the oil and gas activities internationally. Secondly, we are seeing transformative trends in the supply chain sector as well. As we have seen this expansion activities coming up, the project sizes are going up, and at the same time, number of contractors are going up. So there has been a flurry of new contractors, namely coming from Asian countries, China and South Korea coming in and further diversifying the supply chain contractor space. So, and the supply chain sector is also making alliances with these national oil and gas companies and energy companies to diversify as well as adopt new technology. So, looking forward to how that partnership forms up. Thirdly, and most importantly, unconventionals. So up until now, we looked at the entire debate or entire sort of equation from a conventional point of view. The further growth After offshore, the dark horse there, as I would like to call it, is unconventional. We are seeing a dent already created by Zafura unconventional gas project in Saudi Arabia, which has 2 billion cubic feet per day of capacity, very high liquids content. And we see similar upside coming up in the UAE, which are a bit earlier in earlier stages, doing drilling more than 100 wells to further appraise and firm up these resources. So these are this is the unconventional space where we believe it would further accelerate the supply growth or resource base in the region. So these are the core sort of signposts that we are following closely in the region.
And Valerie, in refining and markets, what are you keeping an eye on?
The Middle East is in the optimum position to serve the markets both east and west of the Suez. I think trends that we are watching out for, of course, in terms of refinery utilization in the Middle East, is we expect an increase in utilization of refineries. Currently, they're in the low 80s, mid 80s level of in terms of utilization for the complex refineries in the GCC, so refineries in UAE, Kuwait, and Saudi. They are utilized at only about 80-85%. Certainly, there's room to increase more and pump out more products. We're seeing that European refineries they're past their peak, and we should expect more attrition happening in Europe. And the Middle East is in prime position to take advantage of that market. The other thing is on sanctions. The increasing focus on sanctions on Russian and Iranian barrels are putting a lot of pressure to crude supply, or at least the choices for crude in refineries in Asia, which is eventually going to put pressure on margins. And again, the ability of the Middle East to push products towards the East will help balance that market, will help keep product cracks in check. So I think the Middle East plays a big role as the balancer of product cracks east and west of the Suez, and the region really has to take advantage of this. And you have the lesser developed refineries in Iran and Iraq, and then if there is more investments to come in the future, I would say that Iraq definitely is has a lot of potential in terms of increasing refining capability and pushing out more valuable products in the market.
So they've got the right products in the right place as we start to look ahead into the market. It sounds like. Aditya, I wanted to bring you in here.
We talked about how Middle East is following up the regional oil and gas space, and they have championed essentially this oil and gas space, and they are venturing out into alternative energies. One of the core trend that we are seeing on top of what Valerie mentioned about sanctions is that NOCs are now venturing outside international assets to further increase their resource bases and ramp up their supply base. We are seeing that happening quite distinctively between the three key NOCs, including Saudi Aramco, QatarEnergy, and ADNOC, where Aramco is expanding into LNG space with their stakes in mid-ocean. We have ADNOC through their subsidiary XRG venturing out for both gas and LNG projects globally. And then we have QatarEnergy, who are focusing more on early stage assets. And that's where I would like to leave it with the seventh, so to speak, signpost, which is NOCs are the new INOCs, as we like to call it.
Unpack that for me. What does INOC mean?
INOCs are essentially national oil companies which also operate in international environment. So we have seen most of these core NOCs, including Aramco, QatarEnergy, and ADNOC, and other NOCs for that matter, focusing mostly on their domestic assets. And we would see increasing role of them in operations of international assets. So that's where I would like to call it NOCs becoming INOCs.
So taking that expertise that they've been building upon within the region and taking it internationally. Valerie, are you seeing a similar dynamic when it comes to their refining operations?
Let's just take Saudi Arabia, for example, and aside from, of course, the significant uh, capacity that they have in terms of refining domestically, they are now partnering with other IOCs all over the globe, areas of growth, such as Pakistan and South America. They now have retail presence there. They have partnered in the US, in the Motiva refinery. They have assets in Malaysia, in Korea, and then, of course, they have a lot of partnership and JVs in China with Sinopec. So definitely you have the Middle East NOCs spreading their presence all over the globe and leaving their footprints. And then I think it's good in terms of security of their supply chain when it comes to where they can send the crude, as competition, of course, from non-OPEC producers becomes more stiff. Then they have these outlets for all their crude and their product to be absorbed.
Particularly with these increasing marketing investments that we've seen, as you pointed out, in places like Pakistan and South America, key growth markets. Look, I think that's a great place to wrap things up. Valerie, Aditya, thank you so much for joining us.
Thank you.
Thank you, Noah, for hosting us.
Let's recap. The Middle East energy industry is evolving rapidly, driven by a series of new realities that are changing everything from where new drilling happens, to shifts in investments, to downstream strategies, to trade flows crossing the region. These changes position the countries and the OPEC Plus producers group to capture increasing market share in both crude and products as demand remains resilient in the years ahead. Looking further into the future, we see continued rapid evolution, both within the region, including advances in AI and the development of shale resources, as well as through the region's national oil companies that are expanding their operations across the globe. Thanks for listening to Let's Talk Energy. This podcast is a RystadEnergy production, produced by Laura Rodriguez-Skaug and Boda Oak. Check out the show notes for further analysis of the topics we've discussed today, and connect with us on social media. We're at RystadEnergy on all your major platforms. While you're there, please leave us a review. Click that like button and subscribe. You can also keep up to date on our website. If you'd like to send us questions or reflect on today's show, go ahead and email us directly. It's podcast@RystadEnergy.com. And most importantly, don't forget to join us next week for more Let's Talk Energy.